What's up everyone, it's Karthik with Moneyvest. So wanted to prepare you guys technically for the next week and also go over a couple different indicators that are now suggesting or flashing a little bit of signals for the markets because the Moneyvest index just crossed over 4. The PCC, which is the put call ratio, also just crossed over 1.1. Futures are currently slightly lower, and S&P 500's price to earnings multiple has just crossed over 23. So there's a few different things that I really want to address in this video to help you better prepare for what could be coming in the markets here. So this right here is the first time, once again, we're crossing over 4 for the Moneyvest index. You can come over and take a look at this as over here. So 4.04 is where we are, the highest level that we have seen since July 16th. The last time we were at over 4.19 to almost as much as 4.2. And of course, prior to that, we were in March of 2024, earlier this year, when we were trading at well over 4.2 once again. So we are now approaching the 7th band, or actually the 6th band. So this right here, 1, 2, 3, 4, 5, 6. So we are now in the 6th band over here, trading at just over 4. The reason why this is so important is because this is our very own metric to better understand the market's positioning from a risk-reward standpoint. And again, you'll understand that every time we have been in this sort of 6th band, the markets have been very vulnerable to a more potential downside or dip or some type of a correction or some type of profit taking or weakness in general. It's very rare that we actually get up to that 6th band. The 7th band is even more rare. That's between 4 and 5. So I don't even think that we have gotten up to this level ever, really. Maybe a few times back in sort of 1990s or even 2000. So you can see the highest level going back as far as April 21. We were at 4.5 almost. We kind of top out at 4.4 here. Going back as far as May 2013, we get up to as much as 4.45. So again, getting up to those levels is extremely rare for the markets, and we're once again back up to that level. And also want to discuss the PCC, that's the put call ratio, which is at over 1.123, right? So actually I'm not going to use this chart. Let's just break it down over here. And this is where we are on the put call ratio. Let's come over to the daily chart, and this is where we are. So on the daily chart, 1.123. And the reason, once again, why this is so important is because this is the market's way of telling us that there are more put options now open in the market as opposed to the call option. And the reason why that could be happening is because institutional investors, traders, hedge funds, they essentially buy put options to hedge for a potential downside, because put options tend to be very cheap in an uptrending market, and that's why it is one of the best insurance policies for them. And the last time, of course, we saw a pretty big spike in the put call ratio as over 1.278 was back on Monday, August 5th, right? So the higher this level goes, the more anticipation there is for a pullback or a correction. Prior to that, we were back in May of 2024. This right here was back in April of 2024. Again, both of these times, we've actually seen markets pull back. So if you combine this put call ratio and you literally just look at these dates, right? So we're looking at April 2024, we're looking at August 2024, and then you come back over to our Moneyvest index. Take a look at this. What's happened? This is April 2024. This is this right here is August of 2024. So every time we've seen that put call ratio go up, the Moneyvest index has come down, and that has created that environment for buying opportunities. That's created that environment for us to once again deploy capital into the markets. Volatility is going to open in about 15 minutes here. Right now we're at just over 15.5, so in the 36th percentile, and it's most likely that it's going to be creeping up above 16 once again. And as we know that September is usually one of those months where the median value for volatility, the median and the average value for volatility has been closer to 25. So 25 going from 15.5 to 25 is going to be a nice 50 to 75% potential increase in volatility, something that we have to be ready for. And volatility futures, in other words, the M1 and the M2 contango levels coming down to just under 12%. The lower it gets down to break even at 0% and possibly turning negative is going to be one of those early signals for us to be a little bit more defensive and very, very cautious in this market environment. And not to mention the price earnings multiple trading at over 23. If you take a look at historically, and this is again going back as far as 5-year, 10-year, 20-year, and 30-year averages. And before we move forward, please make sure that you drop a like and subscribe and share this video with your friends and family. I would really appreciate that. It helps the channel grow and get more people engaged and involved, and that encourages me to do more research and present more data for all of you. So if you take a look at the current average and the current median right now is where we are. we are certainly overvalued, right, from a price to earnings multiple standpoint. Now, some people may argue that we are not really overvalued, in the markets, especially if you look at the valuation for the market excluding for Magnificent Seven. But in my opinion, that's very much cherry picking the data because S&P 500 is, market weighted, and we have to account for all the 500 companies that are part of the S&P 500. So based on a 20-year or a 30-year valuation, based on historical averages, the markets can be said to be overvalued anywhere from 14 to as much as 22%, because historical valuations have been just under 17 to as much as 18, 19 levels, right? So we're trading all the way up to 23 now on a 2024 basis. Definitely does suggest some level of overvaluation. However, in more recent history, so if you come over to a 5-year basis, we have been around 21 to 21.6 levels, which would only suggest an overvaluation of 6 to 7%. For the market, 10-year, we've averaged about 20 to 20.7, also suggesting for 10% overvaluation. But of course, the longer time horizons, the longer we go out, 20 to 30-year, the markets were, of course, cheaper back then because of the lack of technological advancements and the companies trading at such high premiums. And as a result, the average has been pushed out a little bit further on a more recent basis, but longer term basis, it's been a little bit lower. So you can make a judgment call whether you believe the market's currently trading at well over 5,600 here for the S&P 500. So if you come over to SPX, we are at just over 5,650, almost coming back up to all-time highs. I'll go over the technicals in just a minute, whether that's fairly valued for the markets or not. But in my opinion, we are, fundamentally speaking, a little bit more on the higher side, a little bit more on the expensive side, not to mention a lot of technical indicators suggesting for us to be very cautious, as we are, once again, very close to all-time highs, trading well within 1% of all-time highs. So we are still, I would consider this to be pretty much trading at all-time highs. One more thing I want to mention is the indicators related to over here, which is percentages of stocks trading above or below their moving averages. And this is something that I have shared in our previous videos, where it's a good indicator for market breadth. It's both a pro and a con. And the reason for that is pro is because this is a healthy, uptrending, stable market, which is also broadening out to other parts of the market. So other sectors are also participating, with over 91% of stocks trading above their 20 simple moving average, with 81% of stocks trading above their 50 SMA, and about 78% of stocks trading above their 200 simple moving average. So this is not a narrow, concentrated rally. This is a very broad-based rally with a lot of sectors participating. If anything, utilities, energies, staples, and defenses are the ones that are actually leading this market higher, as opposed to the NASDAQ and technology sector, because that has continued to underperform. And one of the ways you can actually see that is through this chart that I've mentioned in my previous videos. You definitely want to take note of, what to do in your trading view analysis. You can simply come over and type in XLK divided by XLU. You can also do the flip of this, XLU divided by XLK. It's going to give you the same information, but what this is telling you is the performance of technology relative to utilities. And the reason why we do this is because utilities tend to be a very, very recession-proof sector. And every single time you'll notice that there has been an underperformance, right? So there's a couple times already we've seen significant underperformance for technology relative to utilities. And that has always happened during times of distress, during times of uncertainty in the markets, where the markets were maybe expecting some type of a recessionary environment, or we were, of course, coming down. And this was, again, back in 2016, back in 2018, back in 2022. And this is the most recent poll on technology's underperformance and the lack of leadership relative to utilities. Now, this can be a bit of a telltale sign, because this is just the market's way of telling us that, look, we're getting a bit more defensive right now in anticipation of what could be happening in the future. Unemployment is scheduled for later this week, but this is still not something that can scare people out of technology, because technology over the long term, I do believe that this is still going to be that trajectory where, yes, on a short-term basis, a pullback and an underperformance and a lack of leadership is still present. However, you really have to decide how long are you investing for, because if you're looking at the long term, looking 3 years, 5 years, 7 years out, this is still, in my opinion, going to be that trajectory where technology's outperformance continues, which really just started after the global financial crisis back in 2008, 2009. So this right here has been the overarching trend for technology's relative performance to utilities. Another way to look at this is also looking at this particular chart. This is a TLT over S&P 500. So what you'll notice is, of course, if you go further back, S&P 500 has been on a very nice, consistent trend higher and higher to almost new all-time highs. And the bond market has really struggled ever since after after the pandemic, and the bull market in the bonds essentially came to an end, and that right there was the top in the TLT ETF. This right here was the bottom, and since then the bond market has really struggled. It's come down, and S&P 500 of course is significantly higher. You can also look at this chart over here. This is S&P 500 over TLT. Also tells us a little bit more about markets positioning from a risk standpoint. And again, you'll notice over here, since 2007, S&P 500 underperformed significantly compared to the bond market, TLT, because the markets shifted over to the bond market as opposed to equities because nobody wanted to take on a lot of risk. And that right there essentially formed a bottom. This right here was another bottom. And since then, we've seen significant outperformance in equities relative to the bond market. However, there is going to be some shifts from time to time where the markets tend to believe or expect uncertainty and then move. There's a flight to quality, there's a flight to safety risk where investors don't want to take on too much risk anymore and they want to move a little bit more towards bonds until they get more clarity on where the markets are headed. And then that's where we are starting to see that flows back into equities. But last month, we actually did witness a pretty long wick because there was a pretty big scare on August 5th because of the carry trade from Japanese yen. And for those reasons, we did see a significant underperformance on S&P relative to the bond market. And of course, that was a longer wait because at one point, this index was down a little bit over 15, almost 16%. And then we quickly shifted back over to a risk-on mode, and the markets recovered with that V-shaped recovery, and the bonds were pretty much left to dust. And again, flowing back over to equity. So that was the longer wick to the downside, and we're back up to almost all-time highs. So that 16% loss was only diminished down to under 4%. So the bottom line is that this has been a very healthy broadening market. But there's a lot of breadth. There's a lot of stocks participating in this market move higher. Technology continues to perform a little bit more. There's lackluster performance from tech. Reasons being very clear because markets still kind of unsure about what the future is going to be for the U.S. markets, whether there's going to be a recession or not. What kind of rate cuts can we expect? And is that going to be accompanied with a weakness in the economy or not? Unemployment rate is going to give us a little bit more clarity. Inflation's due next week. And of course, we got the Federal Reserve meeting for later this month. But I really wanted to break this thing down because the bottom line is that we have to trade the markets we're in, not the markets we're expected or predicting to be in, right? So this is the current situation with the Moneyvest index at over 4. We got the put call ratio at over 1.1. Majority of stocks trading above their moving averages. We're talking in the 90% range for 20 SMA. RSI for S&P 500 over 61. We do, of course, have a valuation, which is at over 23. So from a technical and a fundamental and a macro perspective, from a risk reward perspective, this is a market where I'm going to be a little bit more cautious and more alert kind of buying into this because volatility is also incredibly low at 15.5. So we are at over 36.4 percentile. And this right here is one more thing. One last thing I want to address is the dollar index, which I don't think a lot of people are talking about, and that is going to be the DXY. And the reason why this is so important is because the dollar index and the S&P 500 actually tend to move in very opposite directions. So if I remove for everything and simply highlight, market tops and market bottoms relative to the dollar, and if you come over to the daily chart here, what you'll notice is that there is a very clear pattern between these two sort of indicators, right? So what you'll notice again is as soon as the dollar tops, we see S&P 500 bottom. So this right here is the bottom in S&P 500, and every time we actually do see the dollar bottoming out here. So this is the bottom, this is the top in the S&P, and as the dollar index pushes up, S&P 500 comes down. And as the dollar index comes down, S&P 500 pushes up. As the dollar index comes down, S&P 500 pushes higher. Hopefully you can see that inversion very, very well. This right here is the dollar index pushing up, S&P 500 coming down, then the reversal in the dollar and the S&P 500 pushing up. So that's the inverse correlation. And what we are really witnessing, and once again, you can see that here, dollar index coming down, S&P pushing higher, dollar index coming down here, S&P 500 pushing higher. And now what many people are essentially contemplating is the bottom in for the dollar. So if I remove for the S&P 500 here for 1 second, this right here is the current DXY, the dollar index. We highlighted this as a very strong support, kind of like a range within which we were trading for a very long time. So there is a significant range here between 100.8 to as much as 106.8. So that 6-point range for the dollar index is very, very critical. And we're now starting to see that bounce back higher. This right here is a little bit of that recovery for the dollar index in the last 3 days. And if indeed this is the bottom, as we have already witnessed back in December 2023. And if this ends up, of course, seeing another rally back up to this 106.8 level, well, guess what? The S&P 500 could very much be indicating a top here for us to see a bit of a pullback once again, because that has been a little bit of that negative correlation between those two for the recent history as what we have seen. So dollar strengthening is a little bit of weakness for equity markets and vice versa. So coming over to our technical sort of screenshot here, S&P 500 trading well above their 5, 9, 21, 50, 100, and 200 SMA. NASDAQ 100 and NASDAQ Composite still struggling on the 9 SMA basis. Then we do have TLT trading down between their 5, 9, and 21 SMA, still higher on a longer term basis. And the dollar index has actually recovered on the 5 and the 9 SMA basis. So short term trend is actually pretty strong. If it recovers above this level here, the 21, the 50, the 100, 200 SMA, there's going to be some more momentum in the dollar index once again, resulting in some potential downside for the S&P 500. And of course, XLK still trading below its 5 and 9 SMA. So short-term trend still continues to be pretty weak. But these right here are the sectors that are doing really well. And we've got industrial, materials, healthcare, energy still doing really well. We got financials up on all parts, right? So we got all moving averages. It's trading above those levels, and staples also doing really well. So is utilities. So those are the sectors. Those are the that's where the strength is coming from. But keep a close eye on the dollar index. Keep a close eye on volatility. We just opened, we're a little bit over 15.7, so just over 1.4%. But that's all I've got for you today. Going over to S&P 500 very, very quickly. So this right here is going to be the overall technical breakdown, as we are watching on the 30-minute time frame very carefully. And going to go ahead and turn this level into a support, and 56.40 is going to be that level with a resistance all the way up to 56.69. That's pretty much the all-time high, and the very strong area of support and demand sitting right over there for S&P, where we got bounced off of very well over the last couple weeks here. 55.67, 55.70, those are going to be some levels. And of course, we got the QQQs also struggling to break out of this resistance at 477, 478. So that is going to be that level to keep in mind for the NASDAQ 100 as well. Support level is going to stay put at 468, 469. So hope you all enjoyed this video and a complete update on the markets here. Make sure that you drop a like and subscribe to the channel. Make sure that you also share these videos with your friends and family, other traders and investors that can benefit from all of this data. And as always, happy investing. I'll see you all in the next video.